Good afternoon, everybody, and thank you for joining our webinar this afternoon, which is on M&A during challenging times. What should agency owners be thinking about now? We've seen that M&A activity in the marketing services and media sector is beginning to build, albeit very cautiously. Well-funded acquirers, particularly PE-backed ones, are actively pursuing opportunities and indeed looking for deal flow. Mergers are happening as companies with stronger balance sheets act as safe harbours for those less able to weather the recent storm. And additionally, the strong possibility that capital gains tax will increase from April 2021 is driving some agency owners to consider accelerating a sale. So if you are considering M&A activity in 21 and beyond, what should you be thinking about now? As the industry's leader in advising media and marketing businesses with over 100 specialists in this field, we hope we're uniquely placed to share our insights and help you out with a bit of thinking today. We are going to cover the possible changes to capital gains tax, including what this could mean for agency owners and the other options they might want to consider. Preparing an agency for sale in the current climate, how can you tell if your business is in the right place to achieve your aspirations? What steps could you take to maximise value, maximise the value and not leave any money on the table? What should you be thinking about now? We'll also provide our analysis of the M&A activity that's taken place through 2020 and in early 2021. My name is Mandy Merrin, I'm your chair for today. One of the benefits of being a corporate finance team in an accountancy practice is we can blend tax advice seamlessly into a transaction. And one of the tax practitioners who does just this is for us in the media sector is my partner, Mike Hayes. Mike is going to be talking about capital gains tax changes, while my corporate finance partner, Paul Winterflood, will provide a market update and also what steps to consider to make sure you maximise value. Whilst my fellow director in the corporate finance team, Dan Learman, will consider when is the right time for your business to sell. Questions can be posted in the Q&A function. We will follow up the session with a copy of the slides, some answered questions and a link to the recording of the webinar. So no need to scribble frantically with notes. We'll be following up with the content. We will also at that time provide a feedback poll, and my usual plea on these occasions is to say just please take the 2 minutes to complete the feedback poll. It's incredibly helpful to us to let us know what you would like to hear and how we can do things better for you. So just a reminder, post any questions in the Q&A, not in the chat. And with those words, I will hand over to Mike, who's going to talk to us a little bit about capital gains tax. Mike.
Good afternoon, everyone. Next slide, please. So as Mandy's highlighted, we're all expecting some changes to capital gains tax. Are we going to get them? Well, I'm sure we are. Capital gains tax and corporation tax were not covered by the current government's manifesto promise not to increase taxes. They were limited to VAT, income tax, and NIC. So I suspect capital gains tax is a fair bet, and there has been loads and loads and loads of recommendations and press reports about this. So the questions are, will there be changes? Well, the answer I think is yes. When and what? In terms of when, I mean, the Chancellor is standing up, I think, 4 weeks today. He could conceivably say tax rates for CGT are increased from midnight for transactions after midnight last night. I suspect he won't, but it's not impossible. More likely, any CGT changes will be linked to the fiscal year, which of course ends about a month later on the 5th of April. My suspicion is that we're more likely to get changes announced in the November budget, effective from next April, I mean April 22. But we're not entirely clear. Nobody knows. What are we going to get, though? Well, I mean, there have been lots of talk and lots of recommendations from think tanks about having income tax rates applied to capital gains tax, and there have been counter representations from business groups highlighting the negative impact it would have on investment. My guess is we could go back to the situation we had when Gordon Brown was Chancellor, whereby short-term gains were taxed at income tax rates, but then the longer you held the asset, the tax rate got tapered down to something like 10 or 20%. That would actually raise tax for people who make a sort of quick buck, a quick turn. But obviously then if the taxes are lower, for the longer you hold the investment, it becomes more attractive to those people who want to invest over the longer term rather than the short term. Next slide, please. So what can you do about it? Well, clearly you could sell by the 3rd of March, 5th of April this year or 5th of April next year. I think anyone on this call will tell you that unless you've actually got a sale or an MBO pretty much in progress, the March, April deadlines this year are not going to be achieved. So clearly you can actually have a third party exit if you wish, or an MBO. One of the things I want to cover in a minute is a sale to an employee ownership trust, because this might be a way of actually having a tax effective disposal, even if capital gains tax rates are increased to something much more unpalatable than they are today. Next slide, please. One of the things I would just like to highlight is that any sale is normally going to involve some cash up front and then some earn-out, say about over 3 years, profit related. It is possible to do some clever planning around the way you structure the earn-out. So if we take this situation where somebody sells his or her company for 2 million up front plus some earn-out, which is expected to generate 3.7 million over a 3-year period, if we satisfied the earn-out by the receipt of loan notes, which are later cashed in, the tax we pay up front is purely on the 2 million of cash. We would then pay tax on the loan note consideration as and when the loan notes are in cash. Now, if capital gains tax remains at 20% and he does nothing, that is great, because we're going to use our remaining 1 million of entrepreneurs relief up front and pay 20% tax. But on the other hand, if the chancellor comes along, say April next year, and says, I'm increasing the rate of capital gains tax to 45%, there is an election you can make for tax purposes that effectively ignores that deferral into the loan notes. So what you would effectively have, if you make that election, you would end up paying tax in 2021 on the whole amount of the consideration, which would be 5.7 million. So what that would mean in practice is that you'd be paying tax at 10 and 20% on the whole consideration you expect. You'd be paying the tax early, but it would be at a much lower rate. And that election, if assuming the disposal was, say, in June this year, you wouldn't need to make to January 2024. So it is possible to do some planning around structuring earnouts to actually give the seller some sort of flexibility. And I've actually got a sale happening, hopefully this week, using this sort of planning. Next slide, please. And again. So employee ownership trust. So this could be the godsend for some clients who want to sell, particularly where capital gains tax rates go up. And broadly, an employee ownership trust is a trust set up by the company for the benefit of employees. And what happens is that the owners sell all or some of their shares to the employee ownership trust, and that actually attracts some tax benefits. The purchase of the shares is funded by contributions made by the company to the employee ownership trust upfront and perhaps over a period of time. It is also possible for the employee ownership trust to borrow money from a third-party lender and make loan repayments over a period of time, and then make payments out to the sellers in accordance with the share purchase agreement. Next slide, please. Although I have to say, I've been involved in some EOTs where lenders have actually shown interest. For all practical purposes, that is more difficult than you might imagine. And everyone I've been involved in so far has been completely self-funded by contributions from the company. So that would normally be an upfront contribution out of the sort of surplus working capital the company has, plus further contributions over an agreed repayment plan over a number of years. Next slide, please. What are the tax reliefs? Well, this is the big tax relief. There are three. The first one is that for capital gains tax, there is no capital gains tax on the sale to the EOT. So you can't get better than zero tax. I suppose you could get tax back sometimes. So it's a deferral, and I'll explain the intricacies of that in a minute. So that makes it very attractive for the sellers. There is no inheritance tax if you happen to sell the shares at a bit of an undervalue. And then the third tax break is that the company, once this structure is set up, can make bonus payments to employees who are beneficiaries of the trust and up to £3,600 of those bonus payments can be free of income tax each year, per employee that is. They're not free of national insurance. Next slide, please. There are some conditions, and I'm not going to go through all of them. The trust has to benefit all employees, subject to certain exceptions. They have to be benefited on an equal basis. It is vitally important that the trust has a controlling interest in the company throughout, otherwise you lose some of the reliefs. And the company must be a trading company, and the definition of trading company or trading group is the same as for entrepreneurs relief. Next slide, please. Eligible employees, well, they must be officers or employees of the company, or if it's a group, a company within the group. But people who've owned 5% of the shares or more in the last 10 years cannot benefit. So the sellers will typically, unless they own a small shareholding, say 3%, typically the sellers can't benefit from the trust, and nor can anybody that's a connected person with them. So that would normally be relatives. Next slide, please. Benefiting the employees equally, well, it's not necessarily exactly equal, though you can make it exactly equal if you wish, but you are allowed to weight these bonus factors by reference to remuneration, length of service, or hours worked. And typically, when we put together these sorts of bonus schemes for clients, we normally sort of come up with a points mechanism that enables you to combine one or more of the above factors. So they can be unequal, but they've got to all participate on the same basis. Next slide, please. Payments can be made to personal representatives if an employee's died. You can actually have a qualifying period before any employee benefits. So you could have a probationary period of up to 12 months. An employee can waive their bonus and you can pay it to a charity instead. And you can exclude people on disciplinary grounds, etc., under certain specific circumstances. So if anybody's going through a disciplinary, their bonus can be suspended until the disciplinary has been resolved. Next slide, please. The controlling interest requirement is probably the major condition. The trust must hold more than 50% of the share capital, ordinary share capital. It must also have more than 50% of the voting rights. If the company was to pay a dividend, it must be entitled to more than 50% of the dividend. Or if the company were ever to be wound up, it must be entitled to more than 50% of the assets on the winding up. So, and that is a very important condition. And it does mean you have to be very careful, particularly if the owners want to sell 51% or 55% to the trust. You've got a problem, for instance, if somebody wants to come in and invest for equity, the trust could actually find itself diluted below 50%, which would be a bit of a disaster. Next slide, please. The company must be a trading company or the holding company of a trading group. It's the same definition as entrepreneurs relief. So it doesn't apply to investment companies or trading companies which have got large investment activities. Next slide, please. The capital gains tax relief can be clawed back. So if you fail to meet any of the qualifying conditions in the year of sale or in the following tax year, then the capital gain that was avoided on the original sale gets clawed back and is taxed on the seller. So if we imagine our client is actually selling to an EOT today, and if, for example, on the 30th September this year, the company somehow fails to meet the qualified conditions, maybe the trustees lose control, then the sellers will actually have the gain that was deferred clawed back and taxed on them. Once you've gone beyond the end of the tax year following the year of the sale, any clawback of tax falls on the trustees. And I'll say a little bit more about that, about what you might do. And that would include a sale by the trustees to a third party. So let's move on, please. The sale to the trust must be at market value. There will be stamp duty at 0.5% payable by the trust, which obviously the company is going to have to fund. It is possible to run a share scheme alongside this. So if the current owners want to sell 100% to the EOT, but they realise they've got a couple of key people they want to incentivise separately outside the EOT, there's nothing to stop them running say an EMI share scheme alongside the EOT, just to benefit those one or two key people. And we have actually done that on a number of sales. You just have to be particularly careful about how you do it. If you think a sale onwards by the trust is going to be on the cards or is a significant possibility, you can actually have an offshore trust. So this would typically be a trust based in the Channel Islands. And the benefit of that is that if there's any onward sale or if there's a clawback of relief because the conditions have been failed, then there will be no capital gains tax at that point. And it's up to you to decide based on what you think for your company whether an offshore trust is appropriate. So we've done mostly without, but some with. And then the final aspect of this, which I just want to mention for a minute, excuse me for a second, is employee engagement and governance. The purpose of this legislation was to encourage employee participation in the running of a company or a group of companies. So you do have to actually give this some attention and make some provision for it. However, the law does not tell you what you can and cannot do. So I'm just going to come up with a couple of suggestions. So if we could go to the next slide, please. So typically, when we use our own precedents, our own legal team set this up, unless you want to use an offshore trust, you want to have a UK trust in this case, what would typically happen is that the trading company would form a subsidiary, wholly owned subsidiary, which would act as the trust company. And that would be the trustee of the employee ownership trust. The company would also establish some form of employee council. Now that can be as formal or as informal as you wish. There are no prescribed rules. And what we try to do is use those mechanisms to demonstrate employee involvement. So the employee council may, for instance, be able to appoint one or more directors to the trading company or trading group to give the employees some participation. And as far as the trust company is concerned, the way we've actually set it up is that under our precedents, and as I say, you don't have to follow this, you can do something different, is to have an odd number of directors on the trust company board, one of whom would be an independent director, so somebody who's not involved with the company at all. And then the rest of the directors would be split equally between nominees by the employees and nominees by the trading company. So in that situation, you would actually have, say, we've got 5 directors, there'd be 1 independent director, 2 appointed by the employee council and 2 by the trading company. And they would act as the trustees of the employee ownership trust. And as I said, governance is important because I think when you write for tax clearance, you do have to actually show that the employees are going to be involved in running the company. I certainly think it would be bad form for the existing directors of the trading company to remain totally in place and also be the only directors of the trust company. That might provoke a bit of resistance from HMRC. So some sort of involvement by employees is important. But as I say, there are no hard and fast rules. And if you talk to different people who've done this type of thing, you will find that they've all done something slightly different. And I think, next slide, I think that was it from me. So over to you, Mandy.
Mike, thank you very much indeed. Just a reminder, we'll have some time at the end for questions, so please do post any questions in the Q&A as we go, and we'll pick them up at the end. But now it's time to hand over to Paul Winterflood, one of our corporate finance partners here, who's going to give us a little update on what we're seeing in the market at the moment. Paul, take it away.
Great. Thanks, Mandy. Afternoon, everyone. So for the next 5-10 minutes or so, I'm going to give an overview of the media and Marcom's M&A landscape. We'll take a look at some of the trends and discuss the outlook for the coming 12 months. So at Morkins & Smith, we track deals involving UK companies throughout the media and marketing services sectors. And every quarter we produce a report which analyses the activity. If we roll back 12 months to a different world, we predicted a pretty buoyant market, thanks to more stability, thanks to Brexit being somewhat resolved, and more certainty around the political landscape, whether you view that positively or negatively. The first 2 months of the year started exceptionally well, and even early March, we completed four transactions in a day, which was, again, it was tax driven. Budget day last year was at the start of March, and there was a change to entrepreneurs relief that day, which accelerated deal activity. But immediately after that, the brakes were slammed pretty hard onto the market in the second half of March. The result, as you might expect, was a pretty significant drop in transaction numbers. 2019, we had, in terms of the deals we tracked, there was about 360, and a 45% decline last year to 194. On the next slide, we've analysed the number of deals per quarter, and as you can see, in 2020, there was initially a big drop off into quarter two, before numbers started to recover in the second half of the year. I think actually those quarter two numbers may have probably would have been even lower if there hadn't been a few deals which had been put on hold in quarter one and just slowed down and then eventually completed when people started to emerge from survival mode towards the end of quarter two. So there really was a massive drop off in activity, as you can probably expect. Subsequently, there's then been an uptick every quarter, but we should still note that if you compare quarter four of 2020, 49 transactions tracked to the 92 in quarter four of the previous year, and we've still got a pretty considerable year-on-year decline, particularly when you consider the underlying or the economic or the political environment in quarter four 2019. So there's still a long way for the market to rebound. That being said, there clearly was still some activity, and we'll take a bit of a closer look at that shortly. I think just an overriding observation was that there was a bit of a sell side problem last year, where there were a number of agencies looking for acquisitions because they had decent cash reserves or access to cash, or were performing positively through 2020, but not enough businesses or agencies were being sold as a result of people understandably being in survival mode, particularly initially, or for the latter part of the year thinking that 2020 probably wasn't the year they'd like to sell their agency or business. So on the next slide, we'll look at the major acquirer trends, and over the last 5 years, private equity has been increasing their interest in the media and marketing services sector, and this has been in direct contrast to the acquisition volumes, particularly the holding companies, particularly the marketing services holding companies. If we go back to 2016, there were 95 transactions from the big six holding companies, so WPP, Dentsu, et al. And if we compare that to last year, there were only 8. So clearly there's interest in the sector from other areas, and private equity is a big part there. We'll see when we look at the types of businesses that are being bought shortly, but particularly the trend around digital transformation and direct to consumer propositions and data and analytics is very attractive to private equity. So when we look at the number of transactions, sorry, can you go back to the previous slide? When we look at the number of transactions in the year, just under half of the deals last year were PE backed, and that's very much reflective of the fact that private equity investors need to get a return for their investors. they are very much on the lookout for activity, and they can't press they can't press pause on looking for acquisitions. So there's definitely still money out there looking for acquisitions. Notable deals last year that were private equity backed. MSQ bought Be Heard, so MSQ had backed my LDC. And there were a couple of notable listed companies going private. Cello Health was bought by Arsenal Capital Partners, and Huntsworth was also taken private. I think on a more wider basis, going back to the holding companies, they've been generally more inward looking, focusing on reorganizations, but they've still made some of the deals they have been doing. They've typically been they've particularly been around very specific digital skill sets. I think the final acquirer to mention in the Marcom space is S4. Last year they did 5 acquisitions. They've made a further 2 acquisitions at the start of 2021, and the expectation is that they are going to be very, very active in the coming months and years ahead. And again, they're very much looking for digital capabilities. Final acquirer to talk about is the management consultants, because there's been a lot of noise about those over the past few years. They have continued to acquire, but the acquisitions have tended to be non-UK. I think our internal view is that Accenture are the only management consultancy that are likely to be making that are able to make bold moves into the space. The other management consultants tend to be making acquisitions around the periphery, but Accenture are still very, very active, and they bought a couple of very notable US agency groups last year. So Yesler, a B2B agency group from the west coast of the States, and Creative Drive, a content production agency, and part of Creative Drive was Zebra was Zebra Worldwide. They were actually UK based, so there are UK elements to that, albeit not the main company that was acquired. So on the next slide, we've analysed within the marketing services sector the types of companies being acquired, and as you'd expect, it's heavily dominated by digital agencies. 54% of transactions this year in the marketing space were involving digital agencies being acquired, or digital skill sets. That's up from last year as a proportion, and the next highest here is PR. And given the trends around in 2020 around digital transformation, I think it's I think that probably doesn't come to a surprise to anybody. And then actually within the subsectors of digital, the skill sets that were in particular demand last year, and still are, to be honest, from the conversations that we're having with acquirers, it's marketing automation, performance marketing, e-commerce solutions, CRM, analytics. They were very much in demand, and I think they're going to be in demand for the foreseeable future. Finally, the outlook, and which is on the next slide. What we're expecting at the moment is a pretty strong start to the year. Certainly, as a team, we're exceptionally busy. There's a relatively high amount of deal activity at the moment. I think a lot of that is being driven by companies trying to complete deals in advance of budget day. I think beyond that, it's going to be harder to guess. I think there's still going to be an uptick from the end of last year, and if, depending on what the Chancellor announces at the start of next month, if he announces that CGT rates are going to be going up in 12 months' time, then that will kick off a flurry of M&A activity. Mentioned last year that there was a supply side problem where not enough agencies were coming to market, but there were still buyers. The buyers are absolutely still there, and hopefully I'm optimistic there'll be even more, because more and more agencies are out of survival mode and now starting to think strategically, and that's backed up by the amount of private equity money that's available to make acquisitions. So undoubtedly, a lot of acquirers looking for opportunities, and if you're in the digital space in particular, performance marketing, analytics, ABM, CRM, then it's absolutely is a fantastic time to sell. And there's definitely a lot of agencies out there looking for acquisitions. More broadly speaking, I'd hope that whilst I don't think it's going to be returning to absolute normal, I think it's a lot better than it was around summer last year. So now I'm going to hand over to Dan, who's going to help you assess when the right time to sell may be.
While Dan's moving slides, can I just remind everybody to pop questions in the Q&A? It just helps me track them when we come back to answer them. I've noticed there are a couple in the chat, and I promise I'll come back and check those out. But if we can get questions in the Q&A, that'd be great. Thank you.
Thanks, Mandy. So when is the right time to sell? And timing is always probably the hardest question to answer, almost. So I think of it as sort of a trade-off between three areas, and I find it quite helpful. I think market condition, which Paul's just covered in depth, is definitely one of the factors. It's good to sell in a buoyant market, and I think the signs that Paul was pointing to there of willing buyers and a shortage of quality sellers are very supportive, potentially, of values holding up, and I think that is key. Obviously, we don't have a crystal ball, and no one knows what's going to happen now, but I think you have to plan on the basis that things will be okay, personally, and if they're not, reevaluate. So that's the way I would approach that. The other two main things that I think need to be drawn into this sort of equation, as it were, are what your aspirations actually are, and what you're trying to achieve, and what the business state and the business prospects are currently looking like, and whether those support an exit opportunity that can meet your aspirations. So next slide, please, and I'll sort of dig down into these a little bit more. So aspirations. Now, the first thing to say is, and it's the weirdest thing, but when we talk to people, value and the number is an important factor, but it's not normally the only factor, and it's not necessarily even the most important factor for certain people. So the other big thing that we notice time and time again is when you've got a shareholder body of multiple shareholders, often happens in agencies where you may have had a original founding team, new people coming in over time, you'll have people of different ages, people at different stages of their careers, and people bluntly with different shareholdings, which means that any eventual sale proceeds will have a different impact on their life and what they're trying to achieve. So the first thing you've got to really do is understand what your objectives from any sale process is. And that's on an individual basis across the shareholder group. And you need to ensure that there is sufficient overlap and agreement between the shareholding body, because it's really helpful if you can go in with a unified strategy. The other thing, and it's in here, be honest. It's really important that people are honest with each other, what we're trying to achieve here, because there is no point going through a sale process and getting to the end of it and finding out actually someone wanted something slightly different. It's best to know at the beginning what you're trying to achieve when you're starting a journey, and when you're negotiating, you want to be negotiating with potential buyers, not necessarily with your fellow shareholders. At that point, it's probably the wrong time for that negotiation to be happening. So an honest upfront conversation is really important, and very often we'll facilitate that kind of thing with our clients with a formal aspiration review. But just touching on some of the reasons why there are many different factors, and I don't want to talk too long because Paul's got some more stuff to go through, so I'm not going to go through it all in detail. But yes, value is important, but people who are generally nearing retirement age, for them, something like timing or a clean break may be key factors for them. Whereas, for younger, maybe smaller shareholders who aren't going to receive enough cash to potentially retire, or may not want to retire if they're in their 30s, 40s, there'll be other things such as, you know, the partner who you're selling to, and whether that's an environment you want to work with. And this then also feeds into things like potential deal structures that you'd be willing to consider. You know, people wanting a clean break often want as much cash up front as possible, whereas people who are going to continue with the business and hopefully drive it in a new home to greater degrees of success will want to share in the upside of what they create, and, you know, maybe much more interested in a potential earn-out. So all those things feed in, as well as work-life balance, and, you know, and people always mention to us how they want to develop and reward their team who've helped them get there. That is one of the most common themes we hear. So, you know, finding the right home for a good price is often what we hear, rather than necessarily, you know, we don't care, we just want to maximize every penny. But the key is that we go into any situation, or your advisor, if you appoint someone else, which you shouldn't, to understand and know what you're trying to achieve, so that we can do it in the best way, basically. So that's what I want to say about aspirations. And then moving on to the next slide, please. The next thing is, can your performance actually realize those aspirations? Because if they can't, then either you need to reevaluate those aspirations, or you need to potentially wait till your business can. So I thought it'd be a useful point in time to talk about some research that we've done across independent agencies about what agencies that really succeed, what common factors they have, and also to talk about you know, whether those things are things you should be doing now. So number one, don't procrastinate. The best agencies take their tough decisions and take their medicine quickly. And I think that's really good advice for anybody. But also part of that can also be getting facilitated by getting good external input, whether it's from an advisor or whether it's from a non-executive director, and listening to that challenge. Because one of the things that definitely pulls people down is where you have sort of a group thinking board where you don't have that external view, and that external view is really, really valuable. Choose your clients carefully. Not all clients are created equal, that's for sure. And having run an agency myself, you know, I've been part of those conversations where we have had to fire clients, maybe even retained significant paying clients, because they just weren't good for the agency, whether it's reducing profitability in direct ways, or whether it's even just impacting the morale of the team. We had one client in an agency that I worked in my past where everyone on the team left. And, you know, we have to sit back and say, well, we can recruit replacements for those people, but actually it's the client's behavior that's driving that. And so therefore we don't want to work with that client. And that was the best decision we ever made. I mean, the morale of the whole building was so different a couple of months later. Be clear on your proposition. I mean, what we like to say is try and be famous for something. Try and be in the top 3 of what you do, and that makes you a really attractive business. Recruit for the agency you want to be. Now, this was also something when I was running an agency that we were very clear on. It's not just about recruiting capabilities. It's actually about recruiting the right attitudes and personal traits as well, so that you're creating a coherent culture, and that your agency maintains that feeling and doesn't change. Because you don't just want to fill the agency, you've got to actually make it an agency that people want to work at and people ultimately want to buy. Next thing we've got down here is engage your people authentically. Now that's really important, and lots of people, and there's been lots of press, and we actually at MKS we've been really good at this, at doing these engagement surveys to find out how people are coping and what they want. But the most important thing if you're doing engagement surveys is actually to follow through with it and implement the findings. Yeah, if your staff are telling you things and you want them to be engaged, then you really do need to act. You know, inclusive and collaborative environments are key. Happy staff, we are all people businesses, are what drive profits. Focus on strategic work wherever possible. And this isn't just about, although it's very important, the partner versus supplier relationship, although that is key. But also, you know, when you're doing strategic work, clients really value what you're doing, and you stop being a commodity to them. You become an important person, and therefore you drive those client relationships, but also your staff and your teams find it much more interesting to work on those kind of projects. Lose the long tail of strappy clients. Now, it's really weird when you talk about value to talk about losing clients, but we've all had those clients who have started small and grown, and there's nothing wrong with those, and they're really important things to nurture. But at the same time, we've all had those clients who have stayed small and bluntly have required an overinvestment for the returns that they have. And those clients then I think need to be weeded out as much as you can. And sort of in that same theme, working out what you need to stop doing is sometimes easier than trying to say, what are we really good at? What are we really bad at that we just shouldn't be doing? And it's not where we add the value. And this also sort of links with the next point of taking time to think about your business and your clients' businesses. Work on your businesses when you're coming to this type of decision rather than just in them, is the advice we give people. And then finally, don't get complacent, because complacency is when that starts setting in, that's when you will start losing clients or people, and always be looking for that continual improvement. So those were the factors that we identified, probably from 30 years of advising our clients, and also from the surveys we've done, and it's very, very clear. So that's our advice to you on driving business performance. And now I'm going to hand over to Paul to take you through to the end. Oh, no, I'm not. I've got something else to say. Which was just a touch upon business state and prospects. The important thing here is to make sure that during the coronavirus, there has been some really impactful effects on businesses, both negative and positive. But when we're going into a sale process and trying to understand whether you're at the right time to sell, normalizing the effects of those, both positive and negative, is going to be really important. So that's the exercise we're going to do. And the important thing is to also point out that people buying businesses are buying your future, not your past. So having a really good understanding of what your business prospects are and that your business is ready for sale is key. Paul, sorry.
No problem. Thanks so much, Dan. So in this final section, I'm going to look at some of the things you can be doing to maximise the value of your business. So initially, I'm going to quickly look at what buyers want. So we initially talked earlier about some of the skill sets buyers are after at the moment. And that's always one thing when it comes to saleability. The other key point is then around how the buyers actually assess whether they want to acquire your specific business, because clearly you may be fortunate that you're the only person, you're the only business that does that, but equally you may not be. So what we've done in the way that we work with agencies is we boiled down those points from survivor to thriver, and we've boiled it down into 7 criteria that we look at when we're working with agencies in advance of an exit, or even just on an everyday basis. When it comes down to what buyers are looking for, probably the 3 most important are the ones that we've highlighted. The other grey ones are very important to actually get you to that point and are more taken as a given, but in terms of what the buyers will be wanting to assess, I'd say these are the top 3. So firstly, clients, and clients is very much on a broad basis. So it's in terms of, as Dan was saying, what you're famous for, what your value proposition is, what you're doing for your clients, how you win clients, how you can win more clients, and what you could be doing, what you could do for the acquirer's clients as well. So that's one area. The second core area that is really fundamental in people-based businesses is people. The number one reason that agencies fail to sell, I'd say, is when an acquirer isn't confident that the value will remain in the business post-exit. So a departing shareholder will take their check and leave, and then the agency will evaporate effectively. Therefore, it's really, really important to build value throughout the organisation. Then the final area, which I appreciate the function of the other areas, is financials, but clearly that is absolutely key when it comes to a sale. You need to be in a place where a buyer and a seller can be in the same price range. You need to have the good margins, the income growth, the profitability, hit the KPIs, hit the staff cost percentages, and that will all get into a point where a deal becomes possible. On this next slide, I think this really epitomises the work that should be done in advance of selling, and it makes the difference between an agency which sort of drifts into a sale process and gets a price, or those versus an agency that proactively manages these things and gets really accelerates and really gets a premium price. And it's all around enterprise value drivers. I'm just conscious of time, so this is a very crude example. We've taken 3 agencies, and agency A does £1 million of profit a year, but in terms of value driver, in terms of different value drivers, it performs pretty badly. Next agency, agency B, half the profits, but because it performs better in these various value drivers, it attracts a higher multiple. And then agency C, again, half the profitability of agency A, but it maximizes every single one of these drivers. So an acquirer will look at a business which is doing these things well, and will think, okay, we can there's real growth potential here. Even if it's only doing £500,000 of profit now, I'm willing to pay a higher multiple because I'm pretty confident, based on the operations, based on the value proposition, based on the people, that this agency will go from strength to strength, and the future profitability of that business will be really high. So just really much, very much, the focus around optimizing enterprise value is understanding that it's a relationship between both profitability and multiple that gets you the value. On the next slide, we just prepared in terms of when we're working with agencies, we do an exercise called the MKS 360. And what this does is it assesses an organization's current state of play. So it scores your agency against 36 critical success factors and the key drivers of enterprise value. The aim of it is so that you can identify where the opportunities are, helps you identify what you can be doing to get the value uplift, get you from maybe agency B's position to agency C position. Probably the number one finding that we've found when we've been doing this over the past few years is that a lot of agencies have a score of less than 50% to start with and probably aren't sellable. On the next slide, this just outlines what the findings and what the outcomes of the MKS 360 are, and this is all around enterprise value drivers. So what we're trying to do is something we call the 80-20-80. Your time is a precious resource, so you want to make sure it has the maximum impact. So as part of your enterprise optimization journey, you want to make sure you can be able to identify those areas which will provide the biggest uplift in value, so you can focus your time on it. So in terms of what that looks like, a journey to an exit, and from an enterprise value journey perspective, the next slide takes you to the current state. So that's the point you're at now, where maybe you're starting to think about, okay, how can what is my value, and what can I do about my valuation to uplift it for the future? So that's where you start thinking about the various drivers of value. You start thinking about what you can be doing. The next slide, you've been working on those enterprise value drivers. So maybe it's on BD effectiveness. Maybe you've identified that improving lead generation is the area you need to look at, or maybe it's you need to improve your value proposition because your conversion rates were lower than you'd hoped. Maybe it's around employee incentives. If it's been identified as a potential owner reliance problem, then it may be looking to build engagement, looking to build a second tier, or maybe it's around operational efficiency. It could be around improving job profitability. It could be, as Dan mentioned, around losing the long scrappy tail of clients, so that you're working with a core set of clients who will deliver your profitability. But the key thing is that an agency which is actively working on these things will follow the pink line, because you'll be getting both the profitability uplift as well as the multiple uplift. So you get an acceleration in enterprise value. Whereas an agency which isn't focusing and isn't paying and isn't working on the core drivers of value in a business is likely to follow the grey line, which is an agency which maybe grows at 5-10% a year, which as a revenue percentage, that's impressive, but you're not going to get the big uplifts in value that you would if you really focus on those the core value driver areas. So now on the next slide, again, we've then taken it back to a client that's maybe or an agency that's gone through the journey. We've shown in year one profitability of maybe $500,000 with pretty poor to average value driver ratings. It's improved in year 2, and in year 3, it's turned everything to green. Clearly, that's the dream scenario. But equally, over that time, profitability has increased, multiples increased, and but the kicker is that the enterprise value at the bottom, being the combination of multiple and profitability, gets you the significant uplift. So profitability is just over double, enterprise value trebled. So just wrapping up now, if we could move to the skip forward a couple of slides, please. So in summary, 2021 may well be the year you decide to exit, and would be if we can absolutely advise you on a view on your particular agency. But regardless, it's 2021 is absolutely the time that I advise you to start thinking of, if you haven't already, around the value drivers in the business, and because the sooner you can start to the sooner that you can start to work on those things, you get the uplift in profitability, but it also puts you in the best possible position to be able to sell, whether that's in 1, 2, 5, 15, 20 years time.
Paul, thank you very much. Yeah, absolutely. And we've seen a number of our clients have taken the opportunity to pivot their business proposition to reflect, to respond to current circumstances. So now is always a great time to plan. There's never a bad time to plan. We've got some questions. I've got a couple might be on your toes that take us back to EOT. With an EOT, if 100% is sold, then who runs and controls the business?
Oh, that's a good question. So that is good. And the answer to that is, well, in part, nothing changes. So there is no reason why the existing directors of the company can't remain as directors of the company. Of course, if you're going down the sort of governance sort of route and you want to involve the employees, it may be you have an employee nominated director to work alongside them, but there's no reason why you have to completely clear out the boardroom and have new directors. And if it was my company I was selling to an EOT, I suspect I would like to remain as a director. Even though I'm planning to retire, I'd like to remain as a director until I've actually had all my deferred consideration. So at board level, other than you might have one or more employee directors nominated to join you, nothing much changes. Obviously, the identity of the shareholders changes, and the shareholders will be the trustees, and the trustees have an obligation to look after the beneficiaries. So technically, the trustees could actually remove the board or replace them with other people. But in doing so, they've got to have regard to their duty towards the beneficiaries. So if we're looking at offshore trustees now, which would typically be a trust corporation, professional trustees, they're going to want to have 6 monthly or quarterly catch-ups with the directors to see how the company's going. But if everything's going along and there are no issues, they're not going to get involved in actually doing anything sort of voting off directors at general meetings. And likewise, if it's a captive insurance company, in other words, a subsidiary company, again, you've got 2 nominees of the or one, half the directors are going to be nominated by the company, and the other half by the employees, plus say one independent trustee. Again, they've got to be looking after the interests of the beneficiaries. So they're not going to be exercising their powers to actually change anything fundamentally at board level. So it is something you might want to get comfortable with, but broadly, it's not as drastic as a change as you might think. So I go to the second question, Mandy, and this is one where it says, are any deals involving EOTs done on the basis of, say, selling 60% of the equity up front and the balance after a further period? Well, there is nothing to stop you doing that. So you sell 60% today and 40% in 2 years, say. The important thing to note is that you only get the capital gains tax relief on the first sale. Okay, so in that situation that's postulated, the sale of the 60% will be eligible for 0% capital gains tax, but the further 40% will actually be liable to capital gains tax or what the prevailing rates are. So, but contractually, there's nothing to stop you actually selling it in 2 tranches. Third EOT question, and then can the existing owner sell to an EOT on a part upfront deferred consideration basis? And is there a limit on the capital sum that the existing owner can sell for? Well, the answer is subject to the requirement that you can't sell for more than market value. And that's an exercise that we could actually do. Our corporate finance team could look at the value of the company and come up with an independent valuation. There is actually no monetary limit to the actual capital gains tax relief. And we have had clients actually sell on the basis of upfront cash plus an earnout. So not just a fixed sum with deferred instalments, but actually a profit-related amount. And clearly that can increase in line with the performance of the business. So there's not necessarily a cap on that. So there is no limit on the capital sum, providing it's not at more than market value.
Can I just butt in there, Mike, just for a moment? The limit in practice we find is that it's the company's ability to generate the funds to service the price, because at the end of the day, the only engine generating the profits and the cash to pay out on the sale is the company itself. So setting something which is unrealistic for it to achieve is never going to work. Mike, we're running a little short of time, so the next question on EOTs, is it possible to sell from an EOT structure by setting up another EOT? Is there a short one-word answer to that?
Yes, it's possible. I'd ask why, and I think it would be a capital gains tax disposal. So I don't think it would be attractive to do that.
But it is possible to sell to an EOT, retain a stake in the business, and then both the EOT and the owner can sell on their stakes to a third-party buyer, which could be private equity or a trade buyer.
Indeed.
So question for Paul and Dan here. In view of there's a couple of questions around multiples. So really, in view of the supply side shortfall, what's the impact we're seeing on multiples? And I guess that the next question, what sort of multiples are we seeing in the marketplace at the moment? And I know one of the answers to that is it depends, but would you like to talk a little bit about that?
Yes, sounds good. So I'll start with the supply side impact. So I think in short, multiples have held up. If anything, I've heard anecdotally with the premium assets, because there's less opportunities coming to market. There has been a little bit of upward pressure, particularly that's been more at the PE end. In terms of general pricing, we haven't seen a change between 2020 and 2019. The more important thing is being able to evidence what the underlying levels of profitability are. People talk about EBIT, DAC, and how what the actual impact is of COVID. I think for a lot of acquirers, they will be generally be looking to price things based on a return to profitability. So the business being able to justify that they have recovered and not being unduly impacted by COVID. So, and if they haven't, then carving out 2020.
Yeah. Okay.
Yeah.
Thanks for that. Question for you, Dan. Last two questions, and then we'll wrap up. What's the optimum client dilution or mix?
I mean, it varies on your business, and I don't think there's any hard and fast rules. But one thing to say is, you know, client concentration can worry potential buyers, because obviously, if a lot of your profits and future performance are tied up in that opportunity and it's at risk in the future, that can destroy the value that they've spent. So, you know, as a rule of thumb, I'd try and avoid customer concentration of above 20%, say. But, you know, it's not hard and fast. It very much depends on other factors, such as sort of the length of the client contract. You know, you could have a big client with a 5-year contract that would probably be more comforting than a lot of ad hoc work spread amongst lots of different clients, but non-contracted. So it's never straightforward, but yeah, probably avoid things if you can of over 20%.
Yes, I think that certainly would be my rule of thumb. One final question to Paul. We have got one question we haven't answered, but in the interest of time, we'll answer that in our follow-up. Paul, there's a question in the chat. Do you have any thoughts on why the number of deals in Q1 2020 was 66 and had dropped so much from Q1 2019 at 115, given that COVID probably only started to affect deals in the latter part of Q1?
I'd be guessing.
Yeah.
I can't think off the top of my head, so I'll have a think and reply on that separately.
All right. Fantastic. Let's leave it there. Thank you so much to everybody for joining us. I hope you found that useful. Just as I said at the top, we will send out a recording, a copy of the slides, and the sort of FAQ style answer to the questions with a feedback poll. And I'm always so grateful if you could just take 2 minutes to fill in the feedback poll so we can do things better for your benefit. Thank you very much indeed for our speakers today. If anyone has got any specific follow-up questions, we are all more than happy for you to drop us a line directly, and we'll happily have a chat. So that's it, I think. Thank you very much for joining us, and everybody stay safe. Bye-bye.